Good afternoon, everybody, and welcome to our live webinar presentation today. Just a reminder that this is an exclusive presentation for all Retail Insight subscribers. I'm really excited to share my thoughts with you this afternoon on whether or not Shoprite has lost its mojo. But before we get into it, just a couple of housekeeping issues. The slide pack is available for you to download below and will also be available with the replay afterward. Please read the disclaimer at the end of the presentation. Your free copy of our Shoprite result note is also available for you to download. And then please type any questions you have into the question box. I will be pausing regularly to take questions. So without any further ado, let's have a look at where this presentation will take us. Here is the roadmap of our journey during the course of this presentation. You'll see that we're covering all the content we promised, as well as some bonus topics. Let's begin with defining exactly what I mean by mojo. For investors, it comes down to the share price. This is Shoprite's share price from the 17th of September 2009 to 13 September 2019. It has more than doubled in that time frame. And with the exception of the early 2018 Ramaphoria spike to 260 Rand, the Shoprite share price essentially went nowhere from the end of 2012 to September 2018. In the past year, though, it has fallen by around a third. So these moments are always interesting. Is it really cheap, or is it not cheap enough? Hopefully by the end of this presentation, you will have a whole lot of new information that will help you decide. So in deciding that we're going to go through the pillars of Shoprite's investment case and really interrogate them so you can take an informed view. As the slide shows, I think the Shoprite investment case has 6 pillars on which the idea of a deserved PE premium rests. These 6 pillars are its African growth story, reliable earnings growth, positive returns on capital, good cash flow generation, being a defensive food stock, and its market dominance. Let's go through each of these in turn. Shoprite currently operates in 14 countries outside South Africa, as the map shows. It has articulated a compelling story about the African consumer prize, which is largely built around the huge and growing population, and its first mover advantage in winning it. Importantly, it has also left Egypt, Tanzania, and more recently Zimbabwe when the numbers did not stack up. And although not African, it also withdrew from its Indian joint venture when it became clear that the foreign investment regulations were not going to change. So let's unpack the key parts of the African consumer story. The first and arguably most important part is the sheer size of the prize. The United Nations estimates that sub-Saharan Africa currently has just over 1 billion people. It projects this will grow to 1.4 billion by 2030, and by 2062 it will have the world's highest population of any geographic region. But it's not just the growth. We have seen reduced fertility rates, and this means that the working age population is now growing faster than any other age group. This demographic dividend should provide a labor force-driven impetus for growth. The second part of the story is that aside from our immediate neighbors, except Mozambique and Kenya, formal retail is pretty undeveloped. This means that consumers mainly shop in open-air markets, and there's a huge opportunity to expand formal retail. For now, Shoprite is mainly aimed at the premium end of the market outside South Africa. So these 2 factors remain true. But some of the promise that Shoprite saw when it first started expanding outside of South Africa hasn't been fulfilled. The theory was that rising urbanization would fuel increased incomes. In many cases, this hasn't happened, and countries like Angola and Nigeria have massive urban poverty. What we have also seen is that as oil and other commodity prices dropped after 2008, and we've had severe currency depreciations in some countries, sub-Saharan African per capita incomes have dropped sharply in US dollar terms. The soft commodity price backdrop and the knock-on effect on government revenues have meant that infrastructure largely hasn't been developed as planned. And as governments in countries as disparate as Mozambique, Angola, Zambia, Ghana, and Nigeria found that they couldn't service their debt, there were currency depreciations and austerity programs introduced. In Angola's case, it entered an official IMF restructuring process. So the bottom line is that the original base case that these countries would grow well economically and that their currencies were effectively dollarized because of the commodity exposure hasn't been fulfilled. And it's not clear to me that structurally we'll go back to the pre-2008 situation unless the oil price is sustained at over $100 a barrel. Having said that, some things are looking a little brighter. The Saudi attacks meant that the oil price has lifted, and there is scope for countries such as Angola and Nigeria to supply more. But lack of investment in the past few years has meant their production capacity is not what it was 10 years ago. And of course, the long-term projections see peak global demand in 2023. Then there are many potential downside risks to global growth, which would affect demand for commodities, and the US-Chinese trade war is just one obvious risk. The austerity programs will continue to impact local consumer demand as well. Public sector employment is cut, salary increases are capped, and in Angola we had the implementation of a 14% VAT rate on the 1st of July. So there are some potential rays of sunshine that could lift currencies from their depressed depths and reverse some of the 2.8 billion currency haircut that Shoprite took in its asset values outside South Africa in 2019, but it seems unlikely that this will reverse most of the damage already done. Okay, I'm going to pause here for questions. Please, if you have any questions, put them into the question box now. So the first question is, what are the risks around the population projections? I think the key one really is about income levels. Typically, population growth has slowed in countries where income levels have risen. So if things go well economically, there's a good chance that the population growth forecasts won't be met. But ironically, this would be a good thing for Shoprite, as it will mean more formal supermarket customers, not fewer. We are going to unpack the African businesses in more detail once we've covered the whole investment thesis section, but for now, let's move on. I think the second pillar of Shoprite's investment case is built on its historical ability to generate consistent, good earnings growth, driven by amazing positive operating leverage. We saw it generate pretty consistent double-digit HEPS growth from 2007 to 2012, even as inflation unwound from the 2008 and 2009 high double-digit levels. I've shown you the formula on the left. The formula was basically that top line was what it was, the group would extract amazing synergies out of its supply chain, and there was a focus on earning more warehouse allowances from suppliers as its volumes grew. This saw gross margin expand consistently from 2009 to 2017 on the old IAS basis. Then the second silver bullet was that the other income consistently grew well ahead of sales. Again, it sounds as though the suppliers contributed quite a lot of this in the form of advertising and other support. These two things were enough to offset what would have been the negative impact of operating costs rising above sales growth consistently and the jump in interest cost after the convertible bond issue in 2012. But this has broken down in the past 3 years as soggy top line and profitability pressures outside South Africa took their toll. Before we finish up this presentation, we will take a look at what I think the future holds in terms of earnings growth from here. The third element of the case for Shoprite having a premium PE rating rests on its positive value add, with returns on equity exceeding the cost of equity and returns on capital employed exceeding the weighted average cost of capital, or WACC. The spread was still positive up to the end of June 2019. From here, we'll need to focus more on the ROE component because the implementation of IFRS 16 is going to massively increase the asset and capital employed values on the balance sheet. I'll show you exactly what those numbers are a little later. We're moving on now to doing some myth busting. Many people assume that because Shoprite is a food retailer, that it must have good cash flow generation. But as this chart shows, nothing could actually be further from the truth as far as free cash flow is concerned. Shoprite's free cash flow has shown massive swings over the years, and its free cash flow conversion has generally been quite poor. I posted a Retail Insight article earlier that unpacked this for you, but briefly this is the combined effect of its capex being quite high, and some of this is due to its owning its own stores in some places, and then its inventory investment is also quite high. Now it's hard to split out how much of this is due to the long supply chain into the other African countries, but this does play a role. And then, of course, in 2019, it increased inventories to try and compensate for the strike and the disruptions from the SAP implementation. They should work through this in 2020. This poor cash flow generation has a real-life impact on dividends. It was the least generous payer in the sector in terms of dividend cover until Dis-Chem listed, and Pepkor now also has a higher dividend cover than Shoprite, but certainly still in the lower quartile. Then the fifth pillar of the investment case rests on the idea that Shoprite is defensive. Historically, it largely has been, except for times when there have been external events that undermine that. Like in 2001, it lost over 100 million in stock that was stolen mostly by syndicates at its stores' back doors. And now in the last 2 years, as poor economic conditions drove down trading, into the informal sector, and we had hyperinflation in Angola. So as unhelpful as it sounds, Shoprite is mostly defensive until it's not. And right now we are in one of those not defensive moments. The last part of our investment case discussion relates to Shoprite maintaining and growing its market dominance and the related concern of how much more market share it can take. It did lose market share in 2019. Management ascribes this mostly to its SAP implementation hiccups and the DC strike. So hopefully they will get it back. But then I think the more important issue is the dynamic around movement of consumers between the formal and informal sectors. The informal sector has been growing faster than the formal sector ever since the Marikana massacre. I'm not sure if this is coincidence or not, but the low growth economy and job losses have forced more people into buying from spaza shops and other informal retailers. This means lost market share opportunities for all the large supermarkets. If we look at the market in aggregate, assuming the 800 billion rand market estimated by the Reserve Bank in the national data, then Shoprite's total market share is around 15.5%, and it has declined since 2015. So where to from here? Management is confident that last year's market share losses will be reversed as it starts to see the benefits of the SAP implementation. The bottom line here is that Shoprite is quite likely to lose its market leadership position at some point in the future, but I don't think the moment is anywhere close yet. Part of the reason is that the competitors are not bringing the battle to Shoprite, and part of it is that the investments that the group has made in all parts of its business, in the front end, in the stores, and in the back end. And the outcome of that is that it simply has more reach than its rivals, for now anyway. It remains to be seen what the change in strategy emphasis from new space to store optimization will mean over time for this. So let's pull this all together in terms of what you need to think about. The one potential upside is in future market share gains, but the formalization dynamic is beyond its control and will depend on better economic growth. It's not clear to me that Shoprite now has a clear-cut case for a premium PE rating, as it had in the past, but clearly that's for you to decide. So let's pause for some more questions. Please type any questions you have into the question box now. Okay, so why is SAP implementation always such a mess? That's a great question, and there do seem to be an amazing number of teething problems with SAP. So much so that I've heard at least one retailer refer to it as suffering and pain. We know Game is having trouble, and Pick n Pay took years to get through its implementation. Spar also had a few teething issues. So I think the main reason, not to sound too fatuous, is that SAP is German. And as trite as that sounds, what I'm trying to say here is that it really isn't flexible. You have to use SAP the way it was designed to be used, and that means that there can be quite a long learning process for new adopters, and your take on stock levels have to be 100% perfect. Otherwise, it doesn't work. Those issues aside, why do the retailers persist with it? Because it works. It hasn't become the market-leading ERP system for nothing. So I think we do need to be a bit patient. Management is confident that they are through the worst of the teething issues, and we should start to see the benefits coming through now in 2020. All right, so let's move on to the next part of our presentation, which is a deep dive into the African operations. We're going to start off with looking through the currency depreciations and ask the question if there are more important fundamental changes at work as well. And I think there are. So first of all, we have seen these austerity programs introduced in Angola, officially by the IMF, and then Zambia is on its own kind of unofficial austerity program as well. Now, what does that mean for Shoprite particularly? It means that it has really reduced the group's addressable customer base in these markets. And that, of course, is combined then with the impact of lower commodity prices for nearly a decade on consumer incomes as well. You need to remember that Shoprite is effectively the Woolworths in terms of being a premium offer in these other countries. I've already touched on the currency and oil stories, but suffice it to say that there doesn't seem to be too many reasons to expect the currencies to recover back to their previous levels. And the oil price may stay above $60 a barrel, but unless there's more capacity taken out, which could happen in a scary world, it doesn't seem likely that it will move much higher in the near term. And then longer term, the process of oil substitution does seem to be gaining some momentum, and 5 years from now, we should be past peak oil demand. And then lastly, just to talk about Kenya, which is emerging as the new promised land for South Africa's retailers who are moving into the vacuum that's been left by Uchumi and Nakumatt. Kenya is more formalized than the rest of sub-Saharan Africa, but it is a very competitive market with a number of independent traders. And the Kenyan economy and shilling are very dependent on tourism, and so it is geared to global growth. So let's move on to the question of the returns that Shoprite is making on its new investments. These two charts show our estimates of Shoprite's annual new investment in its non-RSA supermarket business, and then the split between current and fixed assets for its whole African business. So that includes the furniture business, pharmacies, and the franchise outside South Africa. We've estimated the annual new investment by adding back depreciation and amortization and the balance sheet currency changes to the annual increase. As you can see, the rand value has dropped off in the past 2 years after a spike in 2017. I think that 2017 increase was driven by not being able to get cash out of Nigeria and Angola, and it's investing in US dollar bonds in Angola as a hedge. You can see this reflected in the growth in current assets relative to fixed assets in the right-hand chart. Right, and then the top table here shows you that the whole African business is very asset-heavy relative to the South African business. This intuitively makes sense as we know that it owns a greater proportion of its stores outside South Africa than in it, and that the supply chain is much longer and more heavily stocked because it doesn't have the same broad base of local suppliers and imports a significant proportion of what it sells. Which brings us to the very important question of what kind of return is it making on this investment. The bottom table shows you that operating return on assets has trended down over time and was negative last year given both the trading loss and the 2.8 billion currency-related write-off in the balance sheet. This downward trend seems to be due to declining returns on new investment, which I've shown in the incremental returns line. Now, to estimate this, I've assumed that the annual increase in earnings was entirely due to the new investment. Clearly, this is an oversimplification, as there should be a benefit of previous investment maturing, so please look at the trend rather than the actual numbers, which are to illustrate the point. But the picture seems quite unequivocal that Shoprite shareholders have effectively lost money invested outside South Africa in the past 2 years. What about South Africa? As this table shows, the broad trend in operating returns over time has been downward. Like the African business, it seems to have lost money on the new investments made in 2019. So, can we go back to what we had? It has to be said upfront that just the population size remains compelling. The UN estimates that half of the world's forecast population increase will take place in just 9 countries. 4 of these, the DRC, Ethiopia, Nigeria, and Tanzania, are in sub-Saharan Africa. But is population enough? The answer is probably no, unless the economics of the model are also fixed. I think the key issue here is about currencies, not just the depreciation question, but more importantly, the mismatch between hard currency or rand funding and local currency earnings, and then in-country, the mismatch between the effectively dollarized cost base, especially for property, and local currency revenues. It is a tough thing because without scale, it's going to be quite hard to achieve good returns on investment, and that implies more investment, so we need to see a way to manage these tensions better. And then just to remind you, please include the Forex changes that you can see in the statement of changes in equity in your assessment of the African businesses, because the currency costs have been huge, some 4.7 billion over the last 10 years, and most of this coming in the past 2 years. So let me pause to see if there are any more questions. Will Shoprite go back to Tanzania if its population is growing so fast? I'd be surprised, but you can never say never. If they manage to execute successfully in Kenya, that could change the mechanisms and costs of operating in Tanzania as well. But I certainly don't think Shoprite management are worrying over that question right now. Right, are there any more questions? Okay, let's move on to something for the bean counters. So Shoprite has given us guidance around its initial estimates of the impact of IFRS 16 on its financials. You'll remember that IFRS 16 is a new accounting standard relating to lease treatment. It effectively brings all leases on balance sheet and does away with the distinction whether a lease is an operating or a finance lease. So Shoprite will recognize a 15.8 billion to 16.8 billion rand right of use asset, depending on currency. It will bring lease liabilities of between 20.7 billion and 21.7 billion rand onto its balance sheet, and earnings will reduce by between 530 million to 830 million rand initially, and most of this cost is actually in Forex. So this initial negative impact will reverse over time, and in 2 years' time, we'll see numbers that are neutral in terms of the change from IAS to IFRS lease accounting, and thereafter the change to IFRS 16 should actually become earnings positive. So we haven't seen a lot of retailers report under the new framework yet. In South Africa, only Massmart has reported so far, and we have seen a few international retailers' new numbers as well. As the table shows, IFRS 16 increased Massmart and Carrefour's losses, and it notionally reduced Tesco's 2018 earnings by 12% and virtually quadrupled its debt. It looks as though Shoprite is really quite sensitive because of the dollar leases, and the guidance implies that earnings will reduce by 12% to 20% relative to IAS reporting. Okay, we're nearly at the end. This is our last discussion, and here are my thoughts on whether Shoprite can get back to a 5% trading margin at group level. And the short answer is that IFRS 16 will absolutely make Shoprite's trading margin higher than 5% because it converts lease costs to finance charges. So I'm going to suggest that we change our emphasis to pre-tax margin instead of trading or operating margins. I'm worried that there is the potential for further slippage in the South African supermarkets trading margin unless we see good volume growth and more inflation coming through. But if we do see the IAS margin dip into the 4% area, please take some comfort that it has become quite unusual to see grocers with 5% plus operating margins globally. The South African supermarkets business remains the obvious risk and the obvious opportunity for the group outcome. We think the austerity programs in Angola and Zambia are a structural change that will challenge the growth in the potential consumer base, at least in the short term. But there's absolutely no doubt that there is massive growth in working age population numbers in the post, and it's just a question of how to remove the currency mismatch risk from the financial model. So let's pull it all together. We have seen a massive derating in Shoprite. Hopefully I've given you some new things to bake into your thought process about whether the current trailing PE of 16.1 times is too low or is still too high so that you can take the appropriate investment action. The group is looking for alternative growth paths, but unfortunately a business as big as Shoprite is at least somewhat tied to the South African economy's fortunes. We have seen a clear indication from management that it is going to become more focused on sweating its existing assets rather than investing, and we should hopefully start to see the benefits of the new systems coming through. The group is addressing that huge growth that we saw on its interest bill by selling off assets, which should give its earnings a non-operational boost, but it does need to address the underlying cash flow generation issue. And there we are. Are there any more questions? Okay, thank you very much for your time and interest. I will post a replay of this in the Retail Insights members area for you all. And please let me know in the question box or by emailing me what topic you would like me to cover in next month's presentation. Again, thank you for your time, and goodbye and good luck.